ULTY is bleeding, YouTube comments are roasting, while all the content creators are dumping their shares. All of this while my margin buffer is one bad day away from getting punched. I'm showing you my exact numbers, the margin map nobody's talking about, and the 3 ways I survived this, so you can decide if you hold, hedge, or bail.
Here we go.
And the quick reminder, none of this is financial advice. This is just what I am doing with my money inside of ULTY. Welcome back, Dividend Stackers. If you're new here, this channel documents my journey building weekly income using YOMAX's ULTY ETF with margin drip and real life decisions along the way. And real quick, if you're getting value or just simply plain entertained from this journey, hit that subscribe button so you don't miss these weekly updates. Now, let's jump into the numbers. So what exactly happened this week? The volatility spiked, sentiment flipped, price slipped, and outflows hit ULTY. Price slid to $4.58, putting me at almost a negative 18% total unrealized P&L and a negative 7.38% true gain loss, even after $1,656 in dividends. My margin used now sits at $4,046.76. And my maintenance requirement sits at $5,963.19, which puts my buffer at just over $1,900 and a 24.24%. And that's because I did have to pay my rent. As you remember, I was using this account to pay bills, one of them being my rent. Okay, so it's getting a little scary here with the margin I have. On the screen here, I have the price and maintenance ratio where a margin call would be triggered. The MMR on the screen stands for margin maintenance ratio. So if MMR stands at 50%, I would trigger a margin call when my market value hits $8,093, which would equal about $3.11 a share. So that's a 32% drop from here, which in our reality can definitely happen in a strong bear market drop. But if Robinhood hikes the MMR to 60%, I would get a margin call when the market value hits $10,117, which is a price about $3.88, which is only 15% drop from here. So definitely got to keep an eye on that margin maintenance ratio, because if Robinhood hikes it to 65%, I would essentially get a margin call when the market value hits $11,562 for my shares, which would be at a $4.44, and that's only 3% below here, which is razor thin. If for some reason Robinhood hikes it to 70%, I'd be instantly out of compliance at my current market value. So for me, the bottom line is the danger isn't just price. It's a maintenance hike while price is weak. I always do speak about income versus optics, and nothing has changed here. The divs keep coming in, but price volatility can overpower my cash flow. In short, especially on margin. October did pay almost $941. And November already stands at $202, with 3 more weeks to go. I do strongly believe the income engine still works, but the chassis, which is the price plus the MMR, is shaking. And on top of all that, the AUM has been slipping. When AUM drops and volatility rises, brokers often bump maintenance on high volume names. If that happens while price dips, weak hands get liquidated, which forces more selling. That's the loop. Now I know you know, and I know, some creators bailed this week, dumped positions, flipped to cover calls, or flat out jump ship. Respect to anyone managing risk their own way, but here's the truth, even the ones who moved on didn't exactly dodge it. Just look at ULTY with the I, KYLD, WPay, and SPY this week. All of them took hits. This wasn't a ULTY only drop, it was a full market wobble. So the takeaway is simple. Don't take financial advice from anyone on YouTube, including me. Every voice, mine included, is just another opinion until you run the numbers yourself. My lane is clear: document, de-risk, and deliver. Weekly cash flow. I show the spreadsheet, the broker screens, the margin map, and the taxes. No cap. What you're watching is transparency in real time. The red weeks, the green weeks, the rebounds, the grind in between. The red, the green, all highlighted here in the true game. Hey, if you respect that kind of honesty, hit the like. Drop a comment and keep riding with me as we learn through every cycle together. It's time for the macro minute where we zoom out and see what's driving the markets this week. Starting with the Fed, the big dial. They released their financial stability report Friday, warning that policy uncertainty and geopolitical risks are still top threats. Translation: even after this week's rate cut, they're still walking on eggshells. Stocks and bonds, the seesaw. At the record highs, the index has cooled off. Tech led the slide as traders locked in profits and waited on shutdown talks. Jobs, consumers, and policy. Sentiment for November slipped around 50.3 and one of the weakest since 2022, and the shutdown's a big reason. But there's finally a glimmer of hope. Senate Majority Leader John Thune told CNBC that talks to end the shutdown have taken a positive turn. Lawmakers are working on funding bills to reopen key agencies. Still no deal yet. We're on day 39 of the longest government shutdown in U.S. history. Housing and mortgages. Freddie Mac has a 30-year fixed at 6.22%, still a major ceiling for home buyers. For commodities, oil held around the high 70s, while gold pushed near $4,000 an ounce as investors looked for safety. And for the crypto check-in, Bitcoin hovered between 100 and 103, still acting like a risk barometer, not a safe haven. Bottom line, a cautious Fed, shutdown talks moving, soft data, sticky rates, and that's why we chop. For income players, buffer up, stay disciplined, and let the cash flow work for you. Drop a comment below if you're stacking income, holding gold, or leaning on crypto next week. Let's see where you're at. So now my survival plan. Basically, my job right here is to raise buffer to 35 to 40% quickly. I'm going to target an extra $1,000 to $1,500 cushion, and how I will be doing this will be probably pausing my drip from 2 to 4 weeks to stock up on cash. We know that YOLTY definitely does continue to pay out cash, so therefore that's going to be one tactic. I do have constant money going in there every 2 weeks, so I know that will help as well. The second part is I will de-risk to survive a 60 to 65% MMR. The optimal method here is going to be to sell 100 to 250 shares only if needed and immediately use proceeds to reduce margin, not to cash out necessarily. So the rules I will not try to break going forward is to keep my buffer at over 35% during my red weeks. Do my best to only drip on green weeks and off on red weeks, at least until the buffer rebuilds. I'll do my best not to have any new leverage below my break-even price of $4.95. And I will review my maintenance mat every day, especially on Fridays before close. For me, this isn't about being right. It's about staying solvent so the income machine can keep compounding while the dust settles. If you made it this far, you're part of the small crew that actually wants to understand what's happening, not just react to the noise. Every week, I'm documenting this journey in real time, the wins, the drawdowns, and the rebuild. Hit that like button if you like the full transparency. Drop your thoughts below. Are you buying, holding, or hedging throughout this volatility? And if you want the same spreadsheet I use to track my margin buffer and weekly dividends, grab it at Buy Me a Coffee at the link below. If you value brutal transparency, smash that like, drop a comment with your buffer percentage and plan, and share this with one YOLTY holder who needs the math. We are inches from monetization. Your watch time today might literally push this channel over the line. Thanks for watching, stay disciplined, and remember, none of this is financial advice. This is just what I am doing with my money inside of ULTY. ULTY YOLO out.